Hey everybody, welcome back to our weekly podcast. My name is Patrick Tan, the GC for ChainArgos, and with me as usual every week, my CEO and Chief Data Scientist, Jonathan Reiter. Thanks for tuning in. Thanks for all the likes, comments, and subscribes. We appreciate it when you do that. And what do we have for you this week? To be honest, the last week has seen a lot of enforcement action, so there's a lot to cover. I mean, we're not going to talk about it all. We're going to talk about the ones that matter to you. I mean, first up, of course, the FBI coin, which everybody's talking about. We've got some data on that, so we'll run through that with you very quickly.
Fund AI,
I mean,
Gen AI
all it was missing was cybersecurity, and then you've got the trifecta, boom, But that would be too obvious, even to the scammers. Like, cybersecurity, AI, and blockchain. That sounds a bit too good to be true. Anyway, then we'll talk about CFTC tokenized money market funds, and you and I had a discussion about that before the show. I was confused as to why anybody would need this, but John will explain it to us in a couple of minutes. Like it didn't make sense to me because I have an interactive broker's account. It just didn't make sense. None of this made sense to me, but we'll see. And then finally, we'll talk about Eigenlayer and the locking that wasn't locking. What the hell's going on with that? So we'll find out a little bit more about that. If you haven't heard about it, John will fill you in on all the deets. But we're going to jump straight into data, so we're going to mix things up a little bit. We don't usually do data right up the front, but this is just too funny, and of course
this data is really
it's good, it's compelling,
sharp.
And it really shouts at you. So all right, so for those of you who don't have the context, long story short, the FBI had a sting operation. Basically they were trying to engage people who were essentially posing as market makers, but essentially wash traders who would just do meaningless trades of your token to generate meaningless.
They made markets, they manufactured markets.
Well, I'm not gonna get bogged down in all this nomenclature. I worked for the phone company, so they had this sting operation to try and engage the services of these people who are essentially just doing wash trading, and then in that sting operation they ensnared a whole bunch of people. Of course they had a fake token that they launched, which props up to the FBI. This is pretty cool. And one of the things that we thought would be interesting to show you is what does a shitty market manipulator kind of look like on a chart. So John's gonna take us through the data, and I think you guys might enjoy this. There you go.
We often, you look at charts, you look at data, and you think, oh, that doesn't look natural. So this is a case where we know the transactions weren't natural because the FBI set up a sting operation and paid people to manipulate, manufacture. So this is sort of to demonstrate how that is extremely visible in data. It doesn't mean the techniques always work 100% of the time, anything like that, but it's a good place to start. So this is daily volume for the FBI token for the entire period that it was traded. Trading is now suspended for obvious reasons. And so what we've got here in blue is the total amount of tokens per day, and what we have in green is the number of unique senders per day. So we can see that at the beginning here, the token got set up, something happened, and then nothing happened for a while, and then here you've got a period of trading for a few weeks. Volumes are reasonably stable in token terms day to day, and the number of sort of transacting addresses is 13 this day, 16. There's a number up here in the 20s. So it's numbers that are high enough that it's not two addresses going back and forth. So I will note that if you look at the largest transactors, this thing went through Uniswap and a number of other sort of trading protocol type things. We know that from the FBI filings. It's not surprising. So this mixes together all of the addresses, both the Uniswap liquidity and other things. As we'll see, that's not, it's kind of neither here nor there, and that it's quite obviously manipulated. So first, if this is the pre-launch period for a token, having a big gap where nothing happens isn't necessarily a bad sign. It doesn't mean anything good or bad, right? And here you've got pretty flat volumes and pretty flat numbers of users. They're low numbers of addresses, but whatever. So that isn't necessarily by itself indicative of anything. If you saw this and the token just stopped dead after a few weeks and you didn't know anybody had been arrested or whatever charged, you would assume something bad had happened, but Okay, so the next thing we're going to do here is look at daily volume by sending address. So these are all of the addresses that sent tokens in the period, the second period in the prior chart. So not the setup for a few days, but the few weeks where transactions occurred. And you can see, look, there's a number of addresses there. We're not even worrying about tagging. It doesn't matter. What's important to notice here is these are, again, all of the addresses. And so each color is a different address. And you see sort of a rainbow as you go across here. But look how similar the daily amount transacted is for so many addresses. So there's a whole line of them here at about 5 million per day. Right? 5 billion per day. There's no natural reason for so many different addresses to be transacting the same amount. Then there's kind of a cluster of them that transact somewhere nearish 10 billion a day. Right? It's not a natural looking distribution. We're going to look at the distribution of transacted amounts in a minute. But it looks very much like there's a cluster in the 5 area and then fewer in the 10 area. And there's this purple guy just above 20, but it's all pretty consistent for a few weeks. You might say, oh, these are, our bots, MEV, market make, whatever. But again, remember, these are all of the addresses transacting. So when a reasonable fraction of all the addresses transacting are doing that kind of stuff, there's not a lot of real activity going on. We're not saying you can identify the FBI outright in data, just dodgy behavior. Now, when you start to average things over larger periods of time, you expect to get smoother looking distributions. So maybe this little feature where they're all stacked at 5 and 10 and 20 would disappear if we perhaps averaged across weeks. So let's do that. Yet not really. You still see clusters of different colored bars at similar levels, right? There's some low ones, then there's some medium ones, and there's this purple guy poking out again. I believe the purple one's actually one of the Uniswap pools, but whatever, because it's the total of all the other amounts. This isn't really natural looking with smooth amounts up and down. This looks fishy, right? This looks suspicious. And then we get to the last chart, which is just absolutely beautiful. So this is total volume by sender on a log scale. The big one over here is one of the DEX addresses. And then what you have is a long tail of, 24 or so addresses that are all transacting almost exactly the same amount. Then just a gap down and a long tail of addresses that are transacting almost the same amount. Right? This doesn't look natural. We're not saying from looking at this chart, this chart, this chart, you can conclude that this is a manipulated token. We're saying if you looked at this and thought, oh, well, that's dodgy, there's probably more stuff to dig in, figure out what's going on here. Right? In this case, you don't have to dig in much longer because the reason people were transacting the same amount over and over and over is because the FBI paid them to transact the same amount over and over. And in that sense, they did their job very well. So these are extremely unnatural looking charts. What you'd normally get here on a log scale is some kind of a top left, bottom right, smooth line going down. Would it be curved like this? Would it be curved like this? Depends, right? But this sort of one high one, then a almost ruler flat line, gap down, ruler flat line, doesn't look natural. Whole bunch of different people transacting at the same amount doesn't look natural. Nothing about this looks natural. The number of transacting addresses drops here, volumes go down, right? There's no actual attempt to get people involved in trading. Right? Look, there's 5 senders on that day, 6 senders. I don't know. Presumably this token wasn't marketed widely because the FBI didn't do a bunch of media and launch events and whatever, pump their token on Telegram. Although that would be pretty funny. So it's not surprising in that sense that the numbers didn't start to explode. But you look at it and it's pretty fishy. Right, it's pretty clearly fishy. Like, this just doesn't look natural. And again, when you add things up, you expect it to get smoother. And when it doesn't really get smoother, that tells you there's structure underneath there. Right? If we broke this down not by day, but back up into weeks or down into hours, you get similar. It remains very discrete looking. Things don't smooth out. And that's a great way of telling that something's manipulated. There's some other statistics you can do here. So we talked about Benford's law before. So in that case, it's a sort of a statistical measure for whether or not numbers look natural that's even admissible in court.
Yeah.
Right. That's a shout out to DMT Capital, who reminded me to mention that that's admissible in court on this one. We are going to look at that. We may put something out. It's not clear if there's enough data here to get statistically useful measures. Again, because there's just not that many days of trading and that many people trading here. So maybe the stats won't really work out. We're not sure.
In any event,
we will look.
Like if you look at, even without applying it, if you look at the sum of transfer amounts, you can tell that this thing's not gonna.
It's not natural.
It's definitely not gonna it would Benford's law would be, if you know anything about it, it's like double the first digit, which should be like 1, and then like they expect less numbers to start with 2 and stuff like that. This thing's going to be completely off the.
It looks like it should be.
It looks like it'd be completely off. So if you want to see how we did use Benford's law for something, we did it on Tron, USDT on Tron, and you can get that on the docs page of the website under the research and docs or something like that. Just look for it. And we applied Benford's law to USDT transactions on Tron, and that it's very obvious, and that's a good place to start. If
We'll definitely write this one up because it's a case where we know with pretty much certainty that almost 100% of the activity in this token was manipulation, because nobody but the people paid by the FBI to manipulate it and traded it.
Yeah.
So it's worth writing up just to document how these methods look in a case where it's nearly completely manipulated, which is super rare for markets. I mean, you do a penny stock that's totally fake. There are just people buying it and selling it, right?
So let's talk about the CFTC's tokenized money market funds as collateral. I was confused as to why this is even a big deal, because my understanding, and correct me if I'm wrong, but if you post collateral, you do get yield or interest or something on it.
Let's go through what this is. So this is CFTC is talking about allowing some supervised firms. So this is leveraged futures and other sorts of trading firms in the U.S. to accept tokenized fund shares as collateral, money market fund shares. So the BlackRock fund, the Franklin Templeton fund, those sorts of assets as collateral for trading. So when you trade futures, which is one of the main things the CFTC oversees, you have to post collateral to cover in case the futures go against you, you lose money, to make sure that you will pay. So some kind of collateral needs to be paid. And here they are. The proposal is to allow people to use tokenized shares in funds. So these are funds that underlying contain government bond, government bill type instruments, and whose value sort of accretes over time as a function of interest paid on that stuff. Now, your comment about collateral. So you trade futures, the exchange requires you to post collateral, and the exchange, as it stands today, pays interest on that collateral, right? So as a bank, whatever, as a fund, as a bank, as a professional investor, I post money to my broker, and my broker posts that money to the CME, or whatever, futures exchange, and the CME and my broker each pay interest back to the guy that posted it to them. They pay interest at SOFR, or depending on the currency, the sort of generic risk-free benchmark rate. That's the standard arrangement for leveraged trading, not just among professionals, but just in general for a long time. Regular old brokerage accounts in general.
Yeah. If you have an interactive brokerage account, you can totally do that.
And setting up, in the U.S., you do money market sweep, whatever, different places.
Charles Schwab, whatever it is, you'd be able to
getting interest on this stuff is relatively normal because it wouldn't make any sense. Banks and large exchanges have to post huge amounts of money to each other. When people talk about capital being tied up in collateral, what they're referring to is the fact the bank still has to fund this stuff. So if you're a bank that's borrowing money from depositors or, in the limit, equity investors, bond investors, right? It's possible that the interest paid on the collateral doesn't meaningfully offset and produce enough return on the capital that you've raised. So it's a funding problem for you because posting a bunch of capital to cover risks to the CME is not a profitable use of that capital, right? But you're still getting the, SOFR, you're still getting the overnight policy rate paid basically on that. And the way that this works in normal finance is that banks and derivative traders and exchanges, whatever, all have arrangements with each other, and they agree a standard rate for what to pay on collateral because, these are large organizations. It needs to be standard. And the way that standard normally works is you just take the volume-weighted average of all the overnight borrowing and lending transactions in that currency in that day. Dollars, the Fed produces SOFR, Sonia in the UK, there's Tona, there's rates in Japan, all over the world. Singapore has rates. Everybody's got rates for this. And what happens is the central bank just tallies up all of the government bond repo rates for that day and takes a volume-weighted average and publishes it. And everybody pays and receives that rate. And it works great because you can't manipulate that rate. Historically, people use stuff related to LIBOR, and it's a whole mess and whatever. But there's a rate. It's fine. Now, tokenized money market fund. So you're an interactive brokers, whatever guy, and you've got your money there that's being paid money out of a money market account already.
Yeah.
Interactive brokers. And that's what's being used as your fund collateral.
Yeah.
Because functionally, you can't onboard with the CME because you're a guy. You're
That's
not
right.
A giant
I'm
bank.
a dude.
You onboard with a broker, a futures commission,
Yeah.
a merchant, whatever, and they onboard with the CME. So your broker has to pay the exchange, the collateral, hourly, whatever, intraday basis, a thing that a human can't guarantee, right? I'm not available constantly. If I get on a flight, I can't default on my margin payments. Your broker makes sure that it can get its money out of you, and it fronts to make all that stuff work properly, and it will pay you interest on your deposits, and because it can just freeze your account and claw back stuff out of your money market 2 days later if there's a problem in the limit, whatever, but it needs to pay the CME now because that's professional terms. Would it help anybody to allow you to hold and post tokenized shares? Well, let's think about the end user first. So say I'm a Robinhood user, and Robinhood is taking my bank account balance and maybe not paying me any interest on it. So would I rather hold a money market fund than have them accept that? Yes. Yes. What's happened there is the platform's screwing the retail end user. You should just demand interest on your platform, right? Fair enough. But that has nothing to do with CFTC oversight because you are not posting anything to the CFTC regulated exchange. The CFTC is still getting assets of value, we'll come to in a second, from your broker, from Robinhood or from Interactive Brokers or Charles Schwab, whoever. What the commercial arrangement they make with their end users is up to them. The CFTC doesn't really oversee that except on some basic fraud and fairness type things. So maybe this would help you, but actually it's just helping you not get screwed by your end broker because your collateral is not really what's being posted in the first place. The CFTC rules don't drive that. Your broker at the moment is probably publishing cash, posting cash and being paid interest at SOFR on cash. So just for a moment, I want to work through the mechanics of how companies post each other collateral and generate interest, and then we'll come back and we'll see how doing this doesn't actually simplify anyone's life at all. And it may make it more complicated, make it less complicated. It doesn't actually seem to help much. And it seems to be driven by a lack of understanding that margin payments pay interest already, although I can come to at the end. I can understand why the purveyors of these tokenized funds are interested in pushing this policy. This all makes sense, I think, in the end. So I'm a bank. All right, I have a bunch of deposits, and I've issued bonds, whatever. So I owe money to depositors. I owe money to bondholders. In some sense, I owe money to shareholders. And I own a bunch of government bonds. I have a bunch of loans outstanding. I own a bunch of corporate bonds. I got cash coming in, cash going out, whatever. And I'm a functioning bank. That's fine. I know what my liquidity needs are, so I have to fund a loan tomorrow, and I can repo my bonds if I want to generate cash. Fine. Now, my trading operation gets a margin call. All right. So the first thing I can do is I can sell some of my assets. Well, I don't want to sell my assets, in part because I'm equally likely to get a reverse margin call, get the margin posted back to me tomorrow, or I have to fund a loan tomorrow, or the loan's going to be repaid tomorrow, cash come back in. Randomly buying and selling assets is not really what I want. So people will normally just repo bonds for cash to cover liquidity needs short term. So that's a loan for cash collateralized by a high quality bond. So that doesn't really change your duration position, your credit position, your bank's position. It's just a short term liquidity arrangement. So I'll do that and get cash, and then I'll just make the margin payment on cash. And I know I'm getting paid SOFR. I know I'm getting paid the reference overnight interest rate in the relevant currency on my cash postings. Everybody goes through these machinations to generate cash, and then they all pay, post and receive cash, and they pay interest to each other on cash. That's the current system. Efficient, inefficient, whatever. Let's say now that instead of cash, I could invest in a bunch of tokenized funds that I could then post. Well, first of all, I could have posted the government bonds I owned in the first place, right? The reason I didn't is that the interest rate that accretes on each government bond depends on which government bond we're talking about. And so then we have to run a whole process to reconcile who gets the accrued interest on the posted collateral versus not. That's admin work that may not be necessary. Okay, so instead I buy a tokenized fund. I post the tokenized fund shares. What rate do those accrete at? Well, it depends what assets are in the fund. We don't really get anywhere. So in the first arrangement, everybody boils their stuff down via the repo market to cash, posts each other cash, pays each other interest on cash at a common rate, nets out, job done. Again, I'm not saying perfect, it works. Now I'm going to post you tokenized fund shares whose prices accrete day to day at whatever rate the fund goes up. But we still have to agree a standard rate to pay each other. So now I have to calculate the difference between how much your fund went up and the index rate that I owe you in the first place, and true that up every day. Is that better? I don't know.
And wouldn't this rate be more subject to manipulation if I wanted to?
Yeah, so which fund I post you will have created a different rate. So the same reason I don't want to be posting people random portfolios of bonds and working out accretion differences. If I post you shares of my fund and you post me shares of your fund, they create at different rates and we have to true up the difference anyway. So, whatever. Truing up the difference is fine. But let's say that I'm a bank, you're a bank. I set up my own tokenized fund, and let's say that my fund doesn't accrete at a very good rate because I trade poorly in the fund that I only allow myself to use, but the one I'm using for posting collateral to people, right? All we're going to have now is banks gaming the accretion rate they're paying each other on their posted collateral and then truing it back all up to SOFR anyway because you have to agree a common standard rate to do this. Now, why might BlackRock and Franklin Templeton and the other issuers of these types of products like this? Because they collect fees on those funds. And if you can get retail investors to say to a broker that may not be paying interest, I want to put my money in this tokenized fund, and I now see that you can just post my fund directly to the exchange, you should let me do this, that feels like a win for the end user because their assets are going straight to the futures exchange. They're qualifying as the collateral. Okay. The problem you're solving there is the end user not getting screwed by a lack of interest paid on their deposits in the first place. And then the broker now, instead of computing the daily amount of SOFR interest they have to pay and receive, has to compute the difference between the accretion in the posted fund price and the amount of SOFR they were supposed to pay and receive. Okay. Does the daily accretion maybe marginally decrease the credit risk? So, it doesn't seem like this actually fixes an admin problem. This feels like an attempt to collect fees by one group in the guise of helping people solve a problem that it isn't really directly solving. If brokers just paid interest to everybody on their deposits, which most brokers do already, then nobody would ever see this issue, and they'd all just happily post each other cash and do SOFR, and that's it. That system is super efficient.
Which is what really confused me, which is like, why would you do this? You already have brokerage accounts that pay interest, and if your brokerage account doesn't pay you an interest, well, then you should move.
I mean, people that don't have access to highly regulated Western financial services in some countries may have more difficulty getting paid interest in their account.
Fair enough.
This is all fair. CFTC allowing the posting of tokenized fund shares will make no difference in that environment. In much of the world, the largest exchanges are North America, Western Europe, and then there's, a couple exchanges, Japan, Singapore's got Hong Kong, some stuff in Southeast Asia, Latin America. But, in U.S. and Western Europe exchanges are the largest, particularly for futures and whatnot, right? You not get direct access to that if you live in a country where they won't onboard you to trade S&P futures and the CME, oil futures and the CME, the Brent futures in London. You don't get access to that. This makes no difference anyway. You just need to get paid interest in your brokerage account. And telling your bank, your broker in your emerging market that it can now use tokenized fund shares, your broker is definitely already involved in trading U.S. government bonds and posting collateral one way or another. Because if nothing else, almost every bank and financial institution in the world has issued dollar debt and done interest rate swaps and has to post collateral against those interest rate swaps. So all of these financial institutions are members of the system I was just talking about already, right? And they're going to be engaged in this daily interest accrual payment and receipt process.
Well, maybe, so if you guys can think of a good reason as to why this should be done, if you're not BlackRock or Franklin Templeton.
If your reason is because I get fees, I hear you.
Fine. Have at it.
I'm open to there being something I'm missing,
but maybe
I just don't
we're missing something.
Is,
So if you can think of a reason why this makes any sense at all, if you're not the one who fees are accruing to, please drop us a DM or leave something in the comments because maybe we missed something.
I mean, for all the comments about how people with larger bank account balances pay lower fees and the rest of it, the bank itself pays no fees on its treasury holdings because who would it even be paying?
That's a good question. Okay, finally, before we wrap up, Eigenlayer and the locking that wasn't locking.
So there's two overlapping interesting features here. So Eigenlayer had an issue. I think this was a couple of weeks ago by now when it began, it finished. So there's two problems. The first problem, two issues. The first is that a whole bunch of investors were given locked tokens, and then it turned out that the staking rewards paid on those tokens were not locked. And there are questions as to how clearly that was disclosed and if it was disclosed consistently over time. And we talked about this a bit at lunch, I think, yesterday. Locked tokens are kind of like restricted stock, but they're not exactly restricted stock. And there's a few flavors of restricted stock. Right?
Yeah.
So if you're an early shareholder in a business that lists and you have restrictions on selling associated with the listing process, generally speaking, you own the shares. The shares pay dividends. Dividends are not a lot of newly listed companies pay cash dividends, but conceptually, you would receive the dividends. It's just stock. You're prevented from selling them through a contract, but you own the shares, right? And there are even cases where people pledge shares that are, what Elon Musk had this collection of shares that had been pledged that got clawed back and then reissued and remained pledged, whatever. But you own them. Now, if you're an employee of a company, you're often issued restricted stock of some sort, restricted stock units, whatever it is. But that stock doesn't really exist yet. There's nothing in your account except a promise by the company to give you stock in the future.
Yeah.
That doesn't have any voting rights. You have voting rights in the IPO case, right? You just can't sell your shares. Maybe you have restrictions on your voting rights. But company restricted stock doesn't have voting rights, doesn't have dividends, doesn't exist, isn't in your account. It exists only in your restricted stock statement that come out of the company on the benefits website. So these tokens are kind of not either one of those things, right? They're a mixture of the two. A lot of people thought that they were of the employee stock,
the
stock
RSU type
They were
things.
just in a box.
Yeah.
No, it turns out that they're out there securing the network, earning rewards. If they're out there securing the network, you need to be clear whether the dividends equivalent, the staking rewards are conceptually something like dividends, whether that stuff's restricted or it isn't. There are cases that look like both versions of that in normal finance, and people just need to be clear in the documentation. These are not new problems, right? It's well understood. If a company IPOs and one of the founders has a large equity holding and they pay a scrip dividend, they pay a dividend of more shares, are those dividends subject to restriction or can be resold or not? In the UK, companies do rights offerings, right? So a rights offering is where the holders of shares are given options to purchase more shares at a discount. All right, so if I own restricted shares as a founder of a company soon after it lists on the exchange and the company does a rights offering, can I sell my rights offering? People sell the option to purchase in the UK.
Yeah.
This needs to be documented. It is not obvious what the answers are. There are common answers and uncommon answers, whatever. But yeah, these are all just standard finance questions that need to be addressed. They're the reason that these documents are 300 pages long, because all of this has happened before. So it was amusing to me that was considered unsettled. The second Eigenlayer issue is even funnier. So here, they appear to have basically been fished. So they didn't use real lock contracts for these locked tokens.
Yeah.
They had legal agreements with the people that were issued the tokens that said they couldn't sell them. And those legal agreements didn't say they couldn't sell the staking rewards, so they sold the staking rewards. In this case, somebody seems to have just, standard phishing attack style, communicated a change of address, and they had the tokens issued to that new address that was not the investment firm in question, and they just sold the tokens immediately. Why you wouldn't use locking contracts for this, I have no understanding. We've seen projects where the locked tokens are issued into locking contracts that allow a designated address, the eventual beneficiary that can withdraw when the lock finishes, to stake them, to do things with the rewards, to exercise control, to hand over control to new addresses, right? So you can sell your locked tokens by transferring the rights to unlock the tokens when the time thing passes to somebody else. We've seen a reasonable number of projects that have this code in production. It's great. I've seen public discussions about, how can you sell locked tokens? Like, well, if they're locked in a contract and I can change the owner from me to you, I can sell him to you, and now you're the owner. You have a good time. You can control the staking, whatever, all this kind of stuff. You can redirect where the staking rewards flow.
Or even simplistically, we can do it off chain. We can just give you the private keys to the address that controls the locked tokens.
I mean, you could do that.
Yeah.
But of course, if you write the code correctly, it's not even necessary
Yeah,
to do that.
yeah,
You can
you don't
make
even
it
need to do
public
that.
that they've been sold may not be public, but they've been transferred public, whatever you do. Because I give you the keys, you don't know if I don't still have the keys. So that's
iffy.
That's a harder.
Yeah.
So this one's just great because there's absolutely no reason for this to have been done the way it was at all. And we've seen examples of projects. I would say of projects that are smaller. This is a big project.
Yeah,
the TVL here, the total value here is large, and it's much bigger than lots of other projects that seem to do this right. I guess it's just easier this way and there's no technology risk if the tokens are not subject to any
I
technology.
mean, yeah, maybe. Yeah, that could be part of the reason.
I mean, there may be smaller funds. This would be kind of ironic, but smaller funds in this area that aren't equipped to accept tokens in some complicated lock contract that requires calling functions because they're small funds. They're not actually technology people. Okay, I mean, fair enough. If that's the reason, I can accept that, although I suspect a lot of people will laugh at a crypto investment fund that isn't capable of managing a smart contract that contains their locked tokens. I also think a lot of people won't be shocked if that turns out to be part of the answer. Or a mandate that doesn't allow or something.
All right.
It's equally funny.
And on that note, I had some comments on the SEC's suit against Cumberland, but we've already gone over time. So I'll leave most of those comments for next week, but I'll leave you with this. If the contention that you think is Cumberland's defense is that none of the tokens that the SEC is alleging are securities, this tells me that you've not read the complaint. So go read the complaint.
We can do this for 2 seconds, right? I mean, the interesting element here is that on the investment contract question, part of the evidence that's presented is effectively investment research that they published on the underlying tokens.
That is correct.
So it is definitely not the case that if you publish investment research on something, it's a security.
No.
But it definitely constrains the arguments you can make, and it's going to be fascinating to watch this. Sorry to cut in on you.
No, but that, yeah. So I'll talk a little bit more about that next week. But this has been an interesting thing where you like, we're not even going to talk about whether or not the underlying tokens are securities because we don't have to, because you talked about them as if they were already securities and you offered them for sale. So you've basically acted as
you publish investment research, so it's different. It's different.
It's a bit, yeah. So it's different, and qualitatively it's different. So
we're not actually up to. We're not taking a position on who's right, who's wrong. What we're trying to say here is this is. It makes you think like, wow, you publish investment research on that. You can't really say that it's just a dumb commodity.
Yeah, it's and also the nature of the research that you published.
I mean, people publish research on gold. Yeah, the nature of the research.
The nature of the research that you published, like they're adding more features, they're doing this, they're growing the network, yada yada yada.
No one talks about adding more features to crude oil.
Yes. So, I don't know. I really would be interested to see how they're gonna. You know what? I'd settle. But anyway, that's me. So on that note,
it'll be interesting. It will be very interesting.
It will be interesting to watch. Thanks for watching. Thanks for listening. Thanks for tuning in. Thanks for all the likes, comments, and subscribes. We went a little bit over, so you got a bit of bonus content this week. But have a great weekend, and we will see you again next week. Bye-bye.